the week ahead. We're going to look at two potential trading nuances we need to understand. And then finally, we'll take a very fast look at the graphic for next week. The first thing I want to talk about is many times it's difficult for short-term traders to appreciate full market dynamics. For example, as short-term traders, we think we fully appreciate what it means when we say a market is too long or too short. It's actually more complex than that. Investment managers, long-term money managers who make their returns based on time in the market and aren't fully invested will underperform if the market rises. They will be affected as if they are short as their performance suffers. These managers are put into a peer group, and then they are rated on a relative basis, not an actual basis, but on a relative basis to the other members of their peer group. So if they are 95% invested and their peer group is, on average 98% invested, those managers that are 95% invested will underperform if the market rises. It's a very competitive business, and there's, millions of dollars at stake that can switch hands very quickly if they don't perform well. The reason I'm addressing this subject is what I suspect has happened in the last couple of weeks, particularly. The market has shown the price is up and it looks the trend is still up, but there's some underlying weakness in the market, particularly in the depth of the advance. I think that there are managers that have built cash positions that were a little bit too large. If you have cash positions, you're not going to be fully invested. As the market has continued to move higher, I suspect that these managers have been forced to buy in order to remain competitive with their peer group. Now remember, they are measured on a relative basis relative to the other members in their peer group, not on an actual plus or minus basis as you and I are. So this buying, what I call forced buying, can apply to investment managers, but also there are some equity hedge funds that I suspect were also underinvested. So that could be one reason for some of the strange buying we've seen lately in the market, and particularly today. The second nuance, and this is one we've talked about before, but we haven't talked about for some time, and it's related to options. If you are a naked call writer, what you want is the market to stay even or, soften a little bit or go up very minor. What you don't want is the market to go up sharply. If you've written the market, if you've written calls, naked calls, and the market advances, you have to buy to cover as you near expiration. And I suspect that that also could be a contributing factor to some of the buying that we've seen late today or early today, trying to bring this into balance. Do I know this for sure? No, but I have talked to some people and I suspect that there's an element of truth into it. All right, now let's look at the graphic for next week. Okay, so today we have an upside breakout. We had a 2-day balance. We had an upside breakout this morning. You'll see the afternoon pullback low came almost exactly to the high of the 2-day breakout, and it also was, equivalent to halfback, very mechanical type of level. If there is any failure to continue upward, the market will return back below the afternoon pullback low and back into the prior 2-day balance. If it gets back into the prior 2-day balance, then the next reference would be the highs, around those highs from several days ago. You'll see the highs up there right around the 5,800 level. So I don't know what's going to happen. We have no real access on the high today. The volume was very, very sluggish. Monday's a holiday in the bond market, so that may make our trading, somewhat less. But I think that the real focus next week will be if the market can hold the upside breakout. Failure to hold that upside breakout then would challenge the 5,800 level. Acceptance below the 5,800 level then can start a more serious counter auction or correction. Thank you. Have a great week.